What is the single most important secret to building wealth in the stock market? If you ask 100 people on the street, you'll likely get the same answers. It's about picking the next Tesla before anyone else. It's about timing the market perfectly, getting in right at the bottom and selling at the absolute peak. It's a game of genius, of insight, of finding that one magic bullet that will make you rich. We spend countless hours hunting for that perfect stock. We obsess over quarterly earnings reports. We hang on every word of financial gurus, hoping to catch a whisper of the next big thing. But what if I told you that all of that is a distraction? What if I told you that the single biggest factor determining your long-term success has almost nothing to do with which individual stocks you own? Today, we're pulling back the curtain on one of the most powerful yet overlooked principles in finance. It's called the 90% rule. Research consistently shows that over 90% of your portfolio's long-term performance is determined by your asset allocation. Let me repeat that. Over 90%. That means the way you mix your investments, the balance between different types of assets, is overwhelmingly more important than any single stock you could ever pick. In this video, we're going to break down exactly what asset allocation is, why it's the quiet driver of wealth, and how you can implement it to build a truly resilient, long-term portfolio. It's time to stop chasing tips and start building a real strategy. So, what exactly is this powerful concept? At its core, asset allocation is simply the strategy of dividing your investment portfolio among different asset categories. For most investors, this means three main buckets. First, you have equities or stocks. These represent ownership in a company. They are the engine of growth in your portfolio. They have the highest potential for long-term returns, but they also come with the highest volatility and risk. Second, you have debt, which primarily means bonds. When you buy a bond, you're essentially lending money to a government or a corporation in exchange for regular interest payments. Bonds are the brakes and the shock absorbers of your portfolio. Their main role is to provide stability and income, especially when the stock market is turbulent. And third, you have alternatives. This is a catch-all category that can include things like real estate, commodities like gold, and other types of investments. These can offer unique diversification benefits. Think of building your portfolio like building a championship sports team. You can't just fill your roster with 11 star strikers. Sure, they might score a lot of goals, but you'd be incredibly vulnerable on defense. To win consistently, you need a balanced team. Your stocks are your strikers. They're there to score points and drive your growth. Your bonds are your defenders. They're there to protect your capital and prevent catastrophic losses during a downturn. And your alternatives, like gold, might be your specialized goalkeeper, providing a unique defense against specific threats like inflation. Asset allocation, therefore, isn't about picking the best player. It's about building the best team. It's the strategic blueprint that dictates how many strikers, defenders, and midfielders you have on the field at any given time. It is the mix that matters. Why is this mix so critically important? The answer lies in one word: diversification. The fundamental truth of investing is that different asset classes perform well at different times. They rarely all move in the same direction at once. The factors that make stocks go up might make bonds go down, and vice versa. Let's look at some real-world history. Consider the period following the 2008 financial crisis. In 2009, as the economy began to recover, equities roared back to life, surging an incredible 78%, while debt instruments declined. If you were only invested in bonds that year, you missed out on a massive, once-in-a-generation rebound. But just 2 years later, in 2011, the script flipped completely. Amid fears of a European debt crisis, equities fell 24%, while safe haven government securities remained flat, protecting investors' capital. If you were 100% in stocks that year, you suffered a major blow. This is the beautiful seesaw effect of asset allocation. When one side of your portfolio is down, the other side is often stable or even up. This smooths out the overall journey. It turns a wild roller coaster ride into a gentle, rolling hill. It's about building a portfolio that is resilient, an all-weather vehicle that can handle the inevitable storms without sinking. It reduces your reliance on being right about any single asset class and instead builds a structure that is designed to endure. If asset allocation is so simple and powerful, why don't more people succeed with it? Because the greatest challenge in investing isn't the market. It's mastering yourself. The number one enemy of a good asset allocation strategy is human emotion. As one financial expert put it, investors often struggle with behavior that disrupts rational asset allocation, frequently buying high and selling low. Think about the last market boom. As stocks soared, the feeling of fear of missing out, or FOMO, was overwhelming. People abandoned their carefully planned mix, sold their boring bonds, and piled into the hottest tech stocks right at the peak. They were buying high, driven by greed. Then, when the inevitable correction came, panic set in. They saw their portfolios drop and sold everything in a desperate attempt to stop the bleeding. They were selling low, driven by fear. This emotional cycle is the single most destructive force in wealth creation, and it completely shatters any rational asset allocation plan. The proper mindset is to understand that the goal of asset allocation is not to predict the market's next move. That's a fool's errand. The goal is to be prepared for it, no matter which direction it goes. A well-allocated portfolio allows you to sleep at night. It gives you the confidence to stay the course, to ignore the daily noise, and to let your long-term strategy do its work. So, how do you put this into practice? It's simpler than you think. Step 1. Know yourself. The first step is to determine your personal asset mix. This depends on two key factors: your time horizon and your risk tolerance. Your time horizon is how long you plan to invest before you need the money. If you're in your 20s and saving for retirement, you have a very long time horizon. You can afford to take on more risk for higher potential growth, which means a higher allocation to stocks. If you're in your 60s and about to retire, your time horizon is short. You need to preserve your capital, which means a higher allocation to bonds. Your risk tolerance is your emotional ability to handle market swings. Can you stomach a 30% drop in your portfolio without panicking? Be honest with yourself. Step 2. Use a simple rule of thumb. You don't need a complex algorithm to get started. A popular and effective starting point is the 100 minus your age rule. Simply subtract your age from 100, and that's the percentage of your portfolio that should be in equities. The rest goes into debt. For example, a 30-year-old would have 70% in stocks, 100 minus 30, and 30% in bonds. A 60-year-old would have 40% in stocks and 60% in bonds. This isn't a perfect rule, but it's a fantastic, logical starting point that automatically reduces your risk as you get older. Step 3. The easy button solution. For many people, the process of choosing investments and, more importantly, rebalancing them regularly can be overwhelming. Fortunately, there's a simple solution. As the financial press often points out, you can use asset allocation-based mutual funds. These are funds specifically designed to handle this entire process for you. You can explore options like asset allocator funds, balanced advantage funds, or multi-asset funds. When you invest in one of these funds, a team of professional managers takes on the responsibility of making the allocation decisions. They monitor the market, adjust the mix between stocks and bonds, and rebalance the portfolio to keep it on track with its goals. This removes emotion and the daily noise from the equation, allowing you to invest in a disciplined, automated way. For too long, the investing world has been mesmerized by the thrill of the hunt, the search for the next big stock, the next multi-bagger. But the evidence is clear. The true secret to building lasting, resilient wealth isn't found in the excitement of the pick. It's found in the quiet, disciplined, and profoundly powerful process of the mix. The 90% rule is a paradigm shift. It tells you to spend less time worrying about which stock to buy and more time thinking about your overall portfolio structure. Are you too exposed to risk? Do you have enough stability to weather a storm? Is your mix appropriate for your age and your goals? Look at your portfolio today. Do you see a random collection of individual bets, or do you see a strategically balanced team built for the long run? Stop being just a stock picker. Become a strategic allocator. That is the quiet secret to long-term success.